battling the relentlessly negative doom and gloom news media. It's the Nick Stenger Show, coming to you live from the Stenger Family Office headquarters. It's your host, Nick Stenger.
All right, ladies and gentlemen, welcome back to the Nick Stenger Show. My name is Nick Stenger. We are Stenger Family Office. For the past 43 long years, the Stenger family has been making its mission to deliver you clarity, and not only clarity, but confidence to help secure your financial future. Man, what a wild time here in the stock market. We hit 6,000 points last week, and now we're just a touch under that. We had a little bit of a pullback from the rally after the election on Tuesday a few weeks ago, but market's still holding very strong here. We had Nvidia's earnings yesterday. This is Thursday, today, November 21st, and Nvidia had some pretty good numbers, so we're going to talk about that. And then I do want to talk about some of the doom and gloom stories that are coming out. We're going to cover some of that and how the bears are pivoting. You've actually seen some of the most bearish people on Wall Street who said that the S&P would end 2024 this year at 4,500 points. Now they're pivoting. They're saying that the S&P is going to go up 10% next year. Well, I don't know how anybody listens to these people anymore. I'm not going to call them out by name. You can go Google these people. They're very prominent at the largest banks on Wall Street. And these are the people who have cost investors literally billions of dollars. It baffles me that these people still have their jobs, let alone a voice on CNBC or Fox Business. And it's nuts. And so all the people like us who have been bullish, who have been calling it balls and strikes as we see it. We have been telling you where we think the weaknesses are. We've told you China's a disaster. And I think it's safe to say we've pretty much nailed the dead cat bounce call. The China trade has really come back pretty heavily here. But I think more importantly, we've been calling it as we've seen it. And the U.S. economy is powered forward. We've nailed that call. Don't want to brag, but we have nailed it. And I only say that because we've kept you on your plan. If you've watched the show, if you're our client, if you've called in and you've been worried about something in the past 3, 4, 5 years now, what have I always told you? I've told you just stay on your plan. Don't worry. Don't panic. Don't let these little corrections throw you off. Just stay on your plan. And you're so happy you did that. So that's why I take it so seriously. Not because I want to say, oh yeah, we were right and you were wrong, but just to say, this is important stuff because it really comes down to dollars, a lot of dollars. And so all these Wall Street strategists who have been bearish, who've said that the sky is falling or that Trump's trade war is going to throw off the entire economy, they've just been blatantly wrong. I mean, they've been so wrong to the point where even the guy from JP Morgan got fired. He lost his job over missing the call. And I think that's what basically should happen. Now, if you were going to pick one way to be for the next 5, 10, 15, 20 years, and you could only be perma something. I said this last week, but if you could only be perma bullish, for example, that would have been the right call. And I think still will be the right call. Now, of course, we're going to pivot. There's going to be times where we think stocks are overvalued. There's going to be times where we think certain sectors or segments of the market are overvalued. But I just think when you look at the S&P today, I actually think stocks are fairly valued here. I don't think we're radically overpriced. We're definitely not underpriced. We're not undervalued unless we see a lot of earnings growth come in here the next couple months, which may happen. I would love to see that happen too. That'd be great. We could talk about some scenarios there, but I do think the market's fairly valued. I don't think we're radically overvalued. And so all the people saying that today that the current stock market reminds them of the late 90s, they're just wrong. They're not looking at the numbers. They're not looking at the data. I've got the Morningstar hat here behind us. Data, mass statistics. We love the data. And when you look at the data, what do you find? You find that in the late 90s, what was happening? S&P level was going up, but earnings, the actual profits, were stagnating. You have the exact opposite today. So yeah, you've got valuations a little higher than they were 10, 15 years ago coming out of the financial crisis in 08 and 09, the GFC. But what do you also have? You have earnings at record all-time highs. You have corporate profits at all-time highs. And this is a function of just a booming economy. And so put aside your political differences. Put aside if you like Trump or hate Trump or love Biden or hate Biden or comma, whoever it is. Just put that on the sideline for a second and just look at the fact that companies are producing incredible amounts of profits. And I'll tell you why I think that is, but before we get into it, this week's episode, are stocks overvalued? I'm going to cut to the chase and just say, no, I don't think so. There are certain stocks that are overvalued, and we'll talk about those too. But overall, I think the stock market is actually fairly valued. What about this Doge? I mean, DOGE. I'm not talking about Dogecoin. I said this to a client this week. I said, have you heard about Doge? And he's like, oh, yeah, you're talking about the cryptocurrency. No. I'm not talking about the cryptocurrency. And we're not in, but by the way, for the record, for Ryder, maybe we're wrong on this, but we're not into cryptocurrencies, especially not for clients. But Doge, I'm talking about the Department of Government Efficiency. This is Vivek Ramaswamy and Elon Musk that are heading up a task force that's outside of the government to look at government agencies and say, are we bloated? Well, the answer is yeah. I mean, the government is definitely bloated. Now, to all of our clients out there who are listening to this that are government employees or former government employees, we love you. I'm not talking badly about government. I'm not talking bad about government employees. I believe government's ordained by God. I think you have to have a functioning government and law and order and personal property rights. I'm just making a comment on, and I think what Doge is trying to do is just look at the fact that when government gets too big as a portion of GDP, of gross domestic product, what happens is it slows down entrepreneurship. It slows down people creating new businesses and thereby creating more shareholder value or wealth creation for the rest of us. And so if you want more innovation, if you want better standards of living for your kids and grandkids, you want entrepreneurs to do that. Andrew Opdyke pointed this out in his presentation at Investor Day. You got to go watch it. It's on YouTube, on our YouTube channel. And Andrew Opdyke said that essentially today, we have more people in the federal government than ever before. And when you do that, you slow down the pace of innovation. And there hasn't been a single senator in history who's invented an app, for example, or who's built a company within the government, of course. There's plenty that have done it and then gone to government. But the government isn't the place that creates wealth. It's the entrepreneur. It's the business owner. And so when government gets too big, what happens is it slows down innovation. And you see inflation go up because typically you're printing more money. A big government is typically enabled by a lot of money printing. And that's why government loves money printing. There's an idea that came into existence right around the Great Financial Crisis called modern monetary theory, MMT for short. And it's a mess. I mean, it's a complete debacle. It's not modern. It's not a good theory, as Brian Westbury's pointed out. And what it's done is it said, hey, you don't have to cut taxes. Don't worry about regulations, of course. Okay. Don't look at anything on the fiscal side of the balance sheet. Don't look at cutting the size of government or cutting wasteful spending. All you have to do, Mr. and Mrs. Politician, is just basically print more dollars into existence. And that's how you're going to grow your economy. And guess what? If you're a politician, which if you're on the left or the right, doesn't matter, Republicans, Democrat, are uniparty, okay? All these people that huddle under the dome together and essentially vote for all the same stuff, big government, big wars, endless wars, tons of spending. Remember, the Republicans and the Democrats have really merged together as one party over the years. Why is that? Because number one, they keep themselves in power. And they love that. They love being reelected, right? You have people like Nancy Pelosi and Chuck Schumer and Mitch McConnell who have literally been there longer than most of us have ever have done anything. So it's amazing to me that these people go in, they make $180,000 or whatever per year, and then they're in government for 40 years, and they come out and they're worth like $200-300 million. A little interesting. You may ask yourself, how is that possible? You're thinking, man, I wish I could invest that well. Well, you can. You can actually track Nancy Pelosi's trades, and you too can be a great investor. There's actually an ETF. I'm not recommending it. This is not investment advice, but there's actually an ETF that tracks it, and it's up like 35% or something for 2024. So all that aside, you have a lot of big bureaucracy that's been enabled by money printing because they don't have to shrink the size of government. They don't have to pass unpopular tax hikes to pay for their spending. They don't have to cut spending. And because of that, they just print dollars into existence. And if you remember Milton Friedman and you remember what he said that inflation always and everywhere is what? It's a monetary phenomenon. It's just too many dollars in the economy chasing too few goods. Great case study of this, and something that you've seen with Doge, the Department of Government Efficiency, not the crypto. I just want to remind you, we're talking about Doge, the Department of Government Efficiency, Vivek and Elon. They actually hosted Javier Milei from Argentina to come in and tell them, hey, this is what we've been doing in Argentina. We had 44-45% inflation, crazy, out of control, runaway inflation. And now under Javier Milei, they've got inflation down to 2 or 3%. That's pretty darn impressive. And what has Javier Milei done? He's cut the size of the federal government. He's cut bureaucracy. He's cut spending, and they've cut effectively regulations. And so if you go back to the last time we've done this, there's a way to track it. It's called the Federal Register pages. You can track how many pages of regulation there are in the United States. Today, we're sitting over 90,000 pages of regulations. I mean, it's literally a stack, probably to the ceiling in this room here, of just rules. And you say, man, we got to have rules. We got to have red tape. We obviously have to have law and order. But when that stack of rules gets too big, what does it do? It burdens the consumer. Think about just very micro, on a very basic level, a local restaurant that you go to. Think about the local Chinese restaurant you frequent or the local pizza shop. And these places, maybe they do $500,000 in revenue. They have very slim margins, maybe making 60, 70, 100,000 a year or something like that, just trying to make a living. And they literally have 6 or 7 stacks of regulations just to run that little mom and pop restaurant. I mean, it's nuts, and so you have OSHA, and then you have the FDA, and then you have the local government, and then you have the federal government you got to comply with, and then you have the state government. And so you say, okay, rules are good. We have to have these rules. But if you talk to most business owners out there, what do they say? They say, Nick, I just want one set of rules. Okay. If you give me the playbook and you say, here's the rules you have to follow, and we're not going to change them every 6 months or every year. These are the rules. If you play by these rules, you can operate your business. Most business owners are like, awesome. Double thumbs up. Sounds great. We can do it. But when you stack 4 or 5 sets of rules on top of them, what happens? Now they need a compliance person just to tell them how to not get in trouble. And if you've wondered how this works in reality, just look at the hospital system. Look at the medical system. The number of doctors in the United States has literally grown by like 1% or 2% or something, a sad amount over the past 50 years. But the number of lawyers and compliance people in these hospital and medical systems has grown like 3, 4, 5 times. And so like when Obamacare came in, for example, what did it do? It pushed all these new regulations on the hospital systems. If you talk to the local hospital administrators, I'm here in Naperville, I talk to them sometimes, they say, Nick, we have more compliance people and attorneys on staff now than nurses. And so that should be really sad to all of us. That's really bad. That's not a good thing, whether you're on the left or the right. And I've always told you this. It's not about left or right. It's not about your political leanings. It's about getting government to a reasonable, manageable level. Because whether you're on the left or our friends on on either side of the political spectrum, we should all want less government, because bigger and bigger government does what? It stomps on all of us. And so just an easy example of this is in Ronald Reagan's day, 1981 to 1989, he came into office. And in 1980, right before he got there, the Federal Registry was 87,000 pages. So very similar to where it is today. By the end of his time in the Oval Office, remember, he's standing there. He has the stack of regulations. He says, we're going to cut as much as we can. By the time he left in 1989, he got the number of pages of regulation down from 87,000 to 53,000, a 40% decrease in the number of rules. And I believe, this may be an unpopular opinion to some, but I strongly believe that because of that deregulation, and yes, some tax reform, yes, some spending decreases, but mostly because of that deregulation, we are still benefiting from Ronald Reagan's policies literally over 40 years ago now. And so I think today what you're going to see, and again, you may not like me for saying this, but I'm just telling you the way I see it, calling balls and strikes as we see it. I believe the new administration, with the help of DOGE, is going to cut regulations substantially. And that could unlock a wave of American prosperity like we've never seen before. So this is not a political statement. This is not to say, hey, vote left or vote right or anything like that. It's just to tell you data alone shows you, I think the market's set for an increase over the long haul, even with a short short-term correction. Maybe we have a little pullback in the meantime. But I think long-term, we're going to see some unbelievable waves of innovation coming. So just stay bullish, and I think good things are gonna come down the road here. By the way, we've gotten it from Democrats in the past, and so Bill Clinton, who was forced to work with a Republican Senate, a Republican House, actually cut taxes. And you saw Bill Clinton come in again, a guy who's a Democrat come in, and the economy rocked and rolled in the 90s. And so there's just no reason to get caught up in the politics. Rather, you got to look at the policies. Okay, that's enough on deregulation. I think we've got good things coming. I just want to make one comment on what the bears are saying right now. And I just want to warn you, don't get lost in the sauce. Why? Because a lot of the bears are saying that, hey, look at Target's earnings. Target's falling apart here. Target was down 20% yesterday. It's down another 3% today. If you look at Target stock the past 5 years, it's literally produced a negative 3% price return, not including the dividend. And so everybody's saying the consumer's weakening. The consumer's really starting to slow down. And I say, okay, hang on a second. I know that's true. I know Target is slowing down and having trouble, but Target's had trouble for a long time. By the way, I don't know if you've been to Target lately, but you can't get out of there for less than $500. It's not Walmart where it's a good value. It's not Costco where they have a membership program. Personally, I don't see the value add. I don't see the value proposition of Target. I've never seen it. Because if you look at, by the way, Williams-Sonoma here, Williams-Sonoma produced an unbelievable quarter, and their stock is up 31% past earnings. So yeah, you have Target down 20% after earnings, but look at Williams-Sonoma, which is arguably even more luxury than Target. And the stock's up 68% for the year. The past 5 years is up 400%. So don't get lost in the sauce. Don't get lost in the noise. Don't get so tied up in one earnings report that you miss the broader picture. And then here's one more example for you. You think, hey, Walmart, okay, Walmart's consumer is actually loving life right now, doing great. They're shifting from the more expensive places, probably leaving Target, in my opinion, and they're going to Walmart. They love Walmart. Walmart's up 66% this year, not an AI company, and up 121% the past 5 years, not including the dividend. So you go, hey, consumer over there is doing pretty well. Don't get lost in the noise. All right, let's talk about the rebalance. Then we're going to cover Nvidia. We're going to wrap up with valuations on the stock market. I don't want to give you my exact prediction yet for 2025, where I think the S&P is going to be. We're going to save that for a few weeks from now. But just really quickly on the rebalance, what did we do? Well, we doubled down on U.S. blue chip large cap companies. We do have a value tilt in our Stenger Family Office portfolios for clients. So if you're part of our ETF portfolios or our stock portfolios, we actually have a slight value tilt, not an overweight, but just a tilt. And why is that? Well, because you've seen such a broadening out of where earnings are coming from. It's companies like Walmart. It's companies like Waste Management. It's companies like Procter & Gamble, or John Deere today is up 5% on great earnings. And I'm not recommending each of these stocks to you individually, but I'm just telling you in a broad portfolio, you're seeing a widening out. We call it market breadth of where the earnings contribution is coming from. So yes, of course, Nvidia is a part of our portfolio. Nvidia had a great quarter. We'll cover that in just 1 second. But you're also seeing some unbelievable results from other parts of the market. John Deere is up 7%, not including the dividend for the year. That used to be a great return, and now everybody's crying because they want 20 or 30. Well, guess what? 7's not bad, plus a 2% dividend. Procter & Gamble is up 16% for the year. That's not an AI stock. How about ExxonMobil? ExxonMobil is up almost 21%, including the dividend for 2024. Not an AI stock. And so, again, not recommendations on an individual level, but as you look at the Stenger portfolios, if you're our client, what you're going to see is a nice weight towards some of these value dividend players that are, in my opinion, going to continue to produce plow horse consistent growth. And then you're going to see on the other side some growth-oriented companies. You're going to see Microsoft. You're going to see Nvidia. You're going to see Apple. You're going to see some companies where we're really producing some unbelievable technology. Arista Networks. You're going to see Netflix, of course. You're going to see just some incredible companies that are growing profits. And I think if you get that mix right, if you have enough in value, enough in growth, you should be just fine. The other comment I'll make is no international. We still don't like international. I think you're going to be very hard pressed to find great companies internationally. And when we run our Stenger quality screens on international stocks, I'll give you a couple examples here. You really don't find much to buy, and so that's the issue. And then you have to deal with currency fluctuations and all the rest of it. So as we go into international screening, and I'll just pull up a basic screen as we're talking here. You look at companies that are currently profitable in Europe and going to remain profitable according to expectations next year. Then you also throw in just a basic screen on company debt. So not overly stringent, but just a couple of basic screens here on debt. You really only find about 87 companies in Europe. If you start throwing some just basic sales growth, and I'm sorry I'm doing this while we're talking here, but if we look at sales growth in Europe, over 25% per year for the past 5 years, there's literally 18 companies. One of them is Stellantis, which is kind of a dumpster fire right now. A lot of them are companies you've never heard of that have a market cap under $1 billion. So wouldn't fit our screens anyways for the portfolio. And so my point is you really don't have that many options. There just hasn't been a lot of innovation, or I would call quality growth in Europe. How about Asia? If we go to Asia, there's only 18 companies in Asia that hit these metrics too. One of them is PDD. But again, if you go out to China and you're going to buy companies in Asia, you've got to really cross your fingers and hope that President Xi doesn't throw their CEO in prison. So to me, that's kind of a risk we don't want to have to take. Imagine if you had to worry about Jensen Huang disappearing in the middle of the night and never coming back. That would be pretty bad for Nvidia, right? Yeah, it would be. So this is why we stay in U.S. And then the last thing is on bonds. I don't think we're out of the woods yet. Some of you have debated me on this, which is great. I love the debates or the discussions back and forth about when do you add duration to the bond portfolio? When do you go out and buy a longer term bond? I think we're way too early. And we've been making this call for a long time. It's been hard to hold our ground. But I'm happy to report to you today that the 20-year Treasury is still down 8% for the year price return and down 35%. So if you said, hey, I'm going to have some safe money and put it in treasuries, and you bought the 20-year Treasury 5 years ago, you'd be down 35% of that money. How about that for safety? So we've said that's a horrible idea. That's a terrible way to do it. What have we done? We've kept you short term, and short term bonds have outperformed with less volatility. I think that's actually going to continue. And why? Because again, if we avoid recession here, if we get out of the woods and we avoid a recession, all that has to happen is the back end of the yield curve goes up. Remember, the Fed could continue to cut the front end of the yield curve. They could continue to cut those short-term rates that they do, the overnight lending. They came out with 50 basis points, 25, maybe another 25 or 50 next year. That's fine. But the back end of the yield curve, the 10, the 20, the 30 year, all the rest of them are determined by market forces. And so if you continue to get the market bidding up the 10-year from a yield perspective, I think you could hit 5% on the 10-year pretty easily. And we're sitting today at 4.4% on a 10-year bond, 4.7% on a 20-year. We're not all that far away from 5. Guys like Jamie Dimon have said, watch out, we could hit 6 or 7. Maybe he might be right. And again, you got to get down to the basics and figure out, why are you buying bonds in the first place? If you're buying bonds for your safe money, you got to be careful with these long-term bonds. So in our rebalance, we stayed short-term again. That's the end of the rebalance segment I wanted to cover. And then let's just quickly cover Nvidia's earnings, and then we'll wrap up with valuations here on the stock market. Unbelievable quarter. Nvidia produced $35 billion this quarter in revenue. They made more profit this quarter than they did in revenue at this time last year. They're up 17% in revenue just from Q2, up 94%. The revenue is up 94% over the past 12 months. Data center revenue, this is what everybody's watching, is up 30.8 billion. That's up 112% the past 12 months. Diluted earnings per share were 81 cents. If you forecast that out, you're basically trading Nvidia now, depending on when you're watching the show, anywhere from 45 to 46 times earnings. You say that's a lot. That's a lot more than the S&P. The S&P is at 24 times earnings current. Nick, when is Nvidia due for correction? Is Nvidia overvalued? I'm not telling you this as stock advice. So don't go buy Nvidia or sell Nvidia off of anything I'm about to say. I'm just giving you an example here. But I think Nvidia is actually fairly valued. I don't think it's radically undervalued like it was at the beginning of the year. They're obviously priced for they have to have a couple good quarters here. They have to keep growing their revenues. But if you look at the analyst estimates now, they're expected to do $5 in profit coming up. And so if you take a $150 stock, divide it by 5, you have a forward PE of 30. Guess what else trades at a 30 forward PE? Apple, Microsoft, Google, Amazon, all these other companies out there that you also own in your portfolio. So should you go take 20% of your net worth and throw it in Nvidia stock? Of course not. But why is Nvidia almost at a $4 trillion market capitalization now? Not because of Fugazi, Woozy, Wazi, not because of a fantasy land earnings, but because of real earnings. We have real money coming in. And so again, this is not 1999 for Nvidia. It's just not. We're not trading at 200 times earnings like Cisco. We're not trading at 400 or 500 times earnings. We're not trading at 1,800 times earnings like Salesforce was when it got into the Dow in 2020 and replaced ExxonMobil. So again, could we have a correction in Nvidia? Could you see 30, 40, 50% downside? Sure. I mean, that's happened 3-4 times in the stock's price. But when you see that, that's actually a healthy thing to see. So I would submit to you today that you should be happy when you see these corrections come in any stock, whether it's Nvidia or some other great company that we own for you in the portfolio. Why? Because it's a healthy cleansing of valuation. It's a healthy weeding out of the speculators. We didn't have that in the 90s. We didn't have any of the speculators get washed out until the tech bubble burst in 1999. And so the past 4 or 5 years, we have not been on a slow melt up. We have not been on an earnings melt up. We've been on a growth train. We've been watching earnings continue to power forward. And so when I started in this business, almost 8 years ago now, I remember when S&P earnings were right around 60 or 100 or 120 or 160. And we never thought that S&P earnings could be 200 or 250. Well, right now, and this is where I would say this gets into our projections for next year. I'm not going to give you my exact number on the S&P that we're looking for, but earnings estimates for 2026 are looking to be about 320. Why are we looking at 2026 profits? Well, we always trade the market today based off of what we think is coming. It's what I've always told you. The market's a discounting mechanism of the future. So if we think good stuff is going to come 6 months from now or a year from now, we're already going to see some of it in the market today. So why did the market rally after President Trump won re-election? Couple weeks ago? Well, because people already knew that Doge was probably going to happen. People knew that we were going to cut regulation. We were probably going to cut the corporate tax from 21 to 15%. So some of the gain is priced in. Some of the market movement is already going to be priced in today. So if we thought that the world was going to fall apart a year from now or 6 months from now, well, the market would already be down pricing that in. And that's what we've seen. We've seen a healthy cleansing of the valuations. Look at COVID. Look at 2020. We had a 30, 40% drop in the stock market in 2 weeks in March of 2020. And then all of a sudden, investors like you and I realized, we said, hang on a second. There's going to be a shift in where we spend money. We're going to shift from services to goods. We're not going to go to hotels and casinos and travel. We're going to buy Pelotons and Traegers and Solo Stoves and watch a bunch of Netflix. And the profits in the market shifted. They didn't go away. And so I think the same thing is happening today. We're seeing a healthy widening out of profits. We're seeing market breadth. We're seeing value stocks really do a nice job of contributing to earnings. And so as we look out to 2025, I think, yes, we're going to have upside. I think we're going to be up at least high single digits plus the dividend. And no, I don't think stocks are radically overvalued. Does that mean a correction can't happen? Of course not. We have corrections all the time. We may give back 2%. We may give back 5%. We may even give 10% back. But when you look at the underlying fundamentals of the economy and the stock market today, I think stocks are going to continue powering forward for a very long time. Thank you for being with us.